Welcome to our first quarter MarketCast. At Arnerich Massena, we've always believed that investors are rewarded by staying in the markets for the long term, and that it's important to not let short-term market volatility distract from building a great portfolio. We also think that we can add value by understanding markets and positioning our portfolios in ways that we can take advantage of opportunities as they occur. Last year, we saw a lot of volatility, with stocks and bonds struggling as the Fed raised interest rates at a furious pace, faster than it has in decades. But then, as we entered a new year, we saw a big change. The Fed significantly slowed the pace of its rate hikes, and investments recovered, and market volatility fell. Let's look at the numbers. Here, in the teal bars, we can see that there was a broad-based rebound across all asset classes in the first quarter. But we also noticed that the red bars show that stocks and bonds are still well below their levels of a year ago. This raises the question, are investments likely to keep rising and soon fully recover, or are the Fed rate hikes now tipping the playing field away from risk-sensitive investments? To explore these questions, I'll turn it over to Senior Research Analyst Arthur Coyne.
Thank you, Bryan. When we look at last year's very steep rise in the Fed funds rate, it's easy to see why stocks and bonds were taken by surprise last year. But lately, the tide's been turning. After hiking by more than 1% for 3 quarters in a row, the Fed raised rates by only 0.5% in the first quarter of this year. So stocks, which thrive on stability, did very well in the first quarter. But now looking ahead, we don't know if the economy is going to have a soft landing or if the Fed's going to push us into a recession. But we do know one thing. We know that interest rates are much higher today than they were a year ago, and that could be a good sign for bonds. So let's look at the bond outlook a little more closely. Here we see some potential return scenarios for bonds. The teal bars are estimates of what bonds should return over a year if interest rates fall 1%. And the red bars are estimates of what bonds should return if interest rates rise 1%. From this chart, we can see there's quite a few scenarios where bonds can produce attractive positive returns over the next year. And while there's no guarantee that bonds will beat inflation, we do think that the outlook for bonds is a lot better now than it was a year ago when all of these bars were several percent lower. But while Fed rate hikes have improved the general outlook for bonds, there's the risk that these rate hikes could be a headwind for stocks. In fact, this chart shows 2 indicators that could be signaling a recession on the horizon. First, we have the gold line, which is the slope of the yield curve, defined as the difference between the 10-year and the 3-month Treasury yield. When the slope of the yield curve is negative, like it is today, a recession often follows in the near future. And the second indicator, the teal line, shows the yearly change in the index of leading economic indicators. When this teal line goes negative, it means that the blended basket of 10 leading indicators is heading lower, which is something that often happens in a recession. And if a recession does materialize, we think earnings could decline, and that could hurt stocks. Here's another reason why higher bond yields could be a headwind for stocks. When we compare the earnings yield on stocks to the income yield on a 12-month Treasury bill, we can see that Treasury bills now look much more competitive with stocks. At the end of the first quarter, the S&P 500 index was projected to generate earnings of 5.5% over the next year, while a 12-month Treasury bill was projected to generate income of 4.7% over the same period. This is the narrowest gap we've seen in more than 20 years. And historically, when the gap has been narrow like this, such as in 2000 and 2008, it's been a headwind for stocks. And while this convergence could last a while, this gap should eventually widen out, either through higher stock earnings yields, which could mean lower stock prices, or through lower Treasury bill yields. But either way, we think the Fed is currently tipping the playing field away from stocks and towards short-term bonds. The Fed rate hikes have also been causing stress for banks, who've had to raise their yields on deposits in order to retain depositors. And banks are now also struggling with unrealized losses in their long-term bond portfolios. In the first quarter, we saw financial stocks trade lower, and in March, regulators had to shut down 2 major regional banks and transfer their holdings to other institutions. With banks under stress, we expect that credit conditions will become tighter and slow the economy. So while a soft landing is still possible, there's also a risk of more market volatility to come. And now to talk about our current portfolio strategy, I'll hand it back to Bryan.
Thank you, Arthur. Stock market volatility often rises during periods of economic uncertainty. For example, during the global financial crisis, the COVID crisis, and last year's rate hikes, there were a lot of days when stocks either rose or fell by more than 2%. And while the market's calm mood in the first quarter is a good sign, we think there could be more volatility coming in the next few quarters as the Fed keeps up its fight against inflation. But volatility is normal and to be expected. When it comes to investing, we think of volatility as being the price of admission for higher long-term results that the market has offered over time. Here we can see on the left that the stock market returns have fluctuated wildly over the last 5 years, rising more than 31% in 2019 and falling more than 18% last year. But when we roll these results up into trailing returns on the right, we can see that longer-term time period stock returns are often remarkably stable. This is why having a long-term mindset can help investors make it through short-term periods of volatility. So when it comes to our tactical views, we see the Fed continuing to hold short-term interest rates high, and we're looking to take advantage of that. We like cash and low duration and hedge strategies as sources of dry powder for potential future equity purchases. But right now, our view towards equities is neutral. And given our concerns about potential short-term volatility, we're favoring our more defensive equity holdings and hedge strategies. But as always, please keep in mind that markets are dynamic and that our views may change as new events unfold. Your advisor will work closely with you on specific opportunities as they become available. If you haven't yet, check out our recently published white paper, Private Equity 101, Understanding the Fundamentals of PE Investing. This paper is meant to help investors gain familiarity with how private equity investing works, the stages and types of private equity investments, and the unique risks and benefits of investing in private markets. You can find the paper to read or download on our website in the blog section. Thank you for joining us today.